Did you know there's a way to get your payment, let's just say from $2,400 a month down to $1,800 a month, and it's legal? I'm going to share with you how. Listen to the end so you can hear all of the strategies that we're using today to make homes more affordable. There's a product called a 3-2-1 buy down, and there's also a 2-1 buy down. And we're using these a lot right now in this market because what we're seeing is affordability is king. So people don't typically buy home price, they buy payment. And when rates go up as fast as they've gone up and as much as they've gone up in the last, let's say 6 months, then it really makes that home that you were looking at before and having a hard time getting under contract on much less affordable today. So the good news is lots of homes are on the market more than before, less competition. You don't have to offer way over asking price, but affordability is an issue. So how do we get around it? Well, we use a 3-2-1 buy down strategy or a 2-1 buy down strategy. Let me tell you how it works. So for example, on a 2-1 buy down strategy, the seller would contribute towards your closing costs. So the seller has to pay for the buy down and you would negotiate that into your purchase price. Instead of asking for, $7,000 less in home price, like trying to go in with a lower offer price, you are better off offering the full price they're asking if the home is worth that. Instead of asking for a price reduction, ask for seller credits to help you buy down your rate for a 2-1 buy down. With the 2-1 buy down strategy, if your existing current rate today was, let's just say 7.375, and that PITI payment, so including taxes, insurance, PMI, was going to be $2,400 a month, with a 2-1 buy down on the first year, your rate would be 2% lower than the start rate. So the first year, your rate would be 5.375 and your payment would be $2,000 a month, PITI. The second year, your interest rate would be 6.375 and the payment would be $2,200 a month. And the third year, it would jump up to 7.375 at $2,400 a month. Now, why this is an okay strategy, even though on the third year, you're going to go to that higher interest rate and stay there for the remainder life of the loan, is the majority of people that are taking these loans out right now know that rates will most likely drop in the next year. That is what all the economists are saying. That is what the expectation is if you looked at history. Last 9 recessions, 8 of them, we saw inflation, which raised interest rates, which drove us into a heavy recession, which then in turn caused rates to come down. So if you were to use this strategy and your plan was to refinance in a year or 2, then you would get the benefit of those lower payments for the first couple of years and then be able to refinance out of that loan. The question we get a lot is, what if I want to refinance in 6 months or in a year and I haven't used all of the buy down money that the seller has provided through that credit that they gave? The nice thing about a 2-1 buy down and a 3-2-1 buy down is all of the money that's given by the seller sits in an escrow account. And so if you don't use all of those funds, let's say you're only 1 year into the program, it's all available still to you, whatever's remaining, and you then get a principal reduction, meaning the balance on your mortgage will be reduced when we refinance that loan. On a 3-2-1 buy down, and keep in mind, these are not set in stone. I'm not giving you APRs. These are simply for instruction of hypothetical, what it could look like. It's only for instructional purposes. We're not selling a rate right now. We're not telling you what the rate is today. That would be impossible to do anyway, because rates have been so volatile. They go up and down all day long, every day. This is simply for instructional purposes to give you an idea of an example. On the 3-2-1 buy down, if you were to start off again with that 7.375 rate, if that was your start rate, and you did a 3-2-1, then on the first year, your interest rate would be 3% lower than the start rate. So if the start rate is 7.375 with a $2,400 a month payment on a $300,000 purchase with 5% down payment, then the first year, your interest rate would be 3% lower, 4.375, and you would have a payment of $1,800. Then on the second year, it would be 2% lower than the start rate. You would be at 5.375, and that payment would be about $2,000 PITI a month. On the third year, you would be 1% lower than the start rate. So you'd be at the 6.375 rate, and that would be $2,200 a month. And then on the fourth year, you would revert back to the initial start rate and have a payment of $2,400 a month. So again, the concept of the 3-2-1 and the 2-1, the big concept is seller pays the buy down. It's negotiated in your purchase contract. It enables you to have a lower payment the first 2 or 3 years of your loan with the expectation that you will most likely want to refinance that loan. And the last thing to keep in mind is a lot of people are using this if they have like student loan debt or some other debts that they want to pay off, and they're going to use the first 2 or 3 years of that home purchase to pay off debt. And then at the end of 2 years or 3 years, when those debts are paid off and they're used to paying those higher monthly payments to those other debts, they will then apply that to their mortgage and be paying the same payment as they've been paying for the last couple of years, but just applying it to the mortgage if they're not refinancing. So I hope that makes sense. I know it's a complicated concept, but it's a legal way to get your payment on a $300,000 purchase with 5% down from $2,400 down to $2,000 or $1,800 for the first couple of years. And from there, we would look to do other strategies like refinance that loan. And I would love to run numbers for you and help you with this strategy. So Michelle Oddo, the Oddo Group, give us a call and let us legally help you get a lower payment. It's a hack, and we think it's a great way to get affordability on a home today. Give me a call.